Hey guys, so in this video, we're going to go over cash value life insurance. Check out this interview with me and Thomas. He's a financial advisor that actually opened up my cash value policy. He's going to break down what cash value life insurance is. He's going to go over my policy. You'll see how much I contribute every year and how much cash value I will accumulate in the upcoming years that I can borrow against at a very low interest rate. And we'll go over my son's policy, the benefits of taking out a policy for your child, nephew, grandson in their early years. You'll see how much I contribute to my son's policy every year and how much cash value he will accumulate in the upcoming years. And since I'm the owner of his policy, I can borrow against it. If you have any questions, leave it down in the comment section. I left links to Thomas's information down below where you can have free consultation calls and he can go over it one-on-one with you, what cash value life insurance is, how much you can contribute, and how much you can accumulate in the upcoming years and you can borrow against for your policy. All right, guys, let's get educated. First of all, of course, thank you.
Yeah, sure.
For your time educating us, educating me even further on life insurance, and hopefully when you have time in the future on other investment opportunities that you know of that I can learn about. If you could start with letting us know about your experience, your background, how'd you get into life insurance and financial advising?
Yeah, good question. So I started, it was from a young age, actually. I was always into math, numbers, finance. I think from elementary school. I would always do math problems. My dad would be having me do mental math, teaching me about stocks as a young boy. So obviously I didn't know what I wanted to do at that point. That was always ingrained from the start when I was young. And then really I'd say it started then my professional experience, you could say, in college. Started initially doing an internship with the Treasury Department. So like the finance route, but that wasn't for me. So then had a different internship where it was like basically a financial planning internship that I started was back in 2019. So did that for a little bit, got some experience while I was finishing up school. And then since now, it's been about 5 years, just been a financial advisor, just learning a ton, educating people as much as I can. And then specifically, so helping with investments and insurance, but definitely an expertise. Love educating people and talking about the strategic use of life insurance, especially like how can that be beneficial? Who does it make sense for? Mm-hmm. Most people in some form or fashion, it's just, hey, how do I make sure it's the right fit for me? And I do things correctly. So that's my background, and now plan to continue the career the rest of my life. So.
Good. That's great. Especially doing internships.
Yep.
Sidebar, I used to, when I went to college for media studies and production. I actually interned for Power 99 for a while. So that's awesome, doing internships on
they're great. They're great. Yeah, it was a stereotypical, hey, do an internship in college and get the job from that. It worked out for me. So.
Now, my next question, if you can tell us what is term life insurance? That's what we usually get in the mail, for all. Yeah. And then what is cash value life insurance? That's really the main topic. And of course, if you can tell us the difference between the two as you explain how they both function.
Absolutely, yeah. So term life insurance compared to cash value life insurance. So term is the one that, like you said, you get quotes in the mail about. It's something people can opt through their employer typically as well, or have individually. What that is just pure life insurance protection, meaning, like use myself, for example. Let's say I have some term life insurance, call it a couple $100,000, maybe a $300,000 term life policy. Anything happens to me, I pass away, that payout, that $300,000 goes to my family tax-free, right? So it's pure family protection. I pay a certain amount of premium monthly, and it will provide a benefit if I ever passed away for a specific time. So it might be like, call it 20 years the term lasts, maybe it's 30 years, maybe it's a little longer, maybe it's a little shorter than either of those specific time period. And if someone passes away in that time period, they have the protection. If not, and the policy expires, right? They're not getting any value out of it. And there's also nothing building inside the policy you can use while you're alive in a term policy. again, it's pure insurance. Where term could be nice is if someone does have a family, maybe they have kids, maybe they're married, and they're tight on their budget, right? They don't have, maybe they're in a spot where they're trying to pay some debt down, or their income's lower, their expenses are pretty high, and they're tighter on income, more so paycheck to paycheck. That can be a way they can get some life insurance at a pretty affordable rate. Even though it's not building anything, at least it provides them some coverage. So that's term. Cash value life insurance then is both life insurance protection. So if anything, again, same thing happens to me and I have cash value, my family's protected, has a lump sum benefit, and also has cash value inside of the policy. Just means dollars or money that's building up inside of it or accruing, you can later tap into or take out to utilize while you're alive, right? Typically very tax efficiently from the policy. So your coverage amount when you're paying into a cash value policy, that's going to last the rest of your life. Essentially, we think about it, it expires the day after you do, right? So it have to be 90, 100, 80, whatever, it's going to last the rest of your life. And then key point also is you can strategically utilize a policy where not only do you have the coverage, but also can you tap into dollars or money in a safe environment and be able to utilize it or access it for mid or long-term things that can come up.
Okay. So for my next question, what is an overfunded cash value policy, and what are the benefits of structuring your policy that way?
Sure. So when we spoke about term and cash value, right? Term insurance is, simply, hey, it's just a coverage protection. Cash value has both the coverage and the cash element building inside of the policy. Now, within that cash value, there are different ways to structure the policy where it can be more cash efficient. Meaning, when you're paying or contributing dollars into that policy, your premiums, whatever gets paid in can do two different things. One is it can essentially just go to both your coverage amount and your cash value, right? It can be both. And in that sense, yes, the cash value, you have a good amount of coverage. The cash value, yes, then does build up over time, but it takes a good amount of years, maybe 10, 15, 20 years to grow or accumulate, right? So it's going to take a while. Yes, you'll see good cash value growth over, let's say 15, 20 plus years, but it's going to take a while to build up because you're covering back insurance costs as well with all of your dollars, right? Alternatively, with an overfunded policy, you're able to take some of your dollars that you're paying in, or your premiums or your contributions into the policy, and put it directly into your cash value. Essentially directly, obviously there's maybe a small cost or fee associated with it, but essentially directly into your cash value, meaning you speed up the accumulation process, because now I have some dollars, yes, that are going both to my coverage and my cash at some portion, but I can have the majority of my dollars that actually go right into the cash value element. So it speeds that up where you're going to see faster accumulation quicker inside of a policy. So especially utilized a lot by higher net worth individuals, business owners, people who have extra discretionary income, and they can speed up the growth of the policy.
You know what that reminds me of a bit of a mortgage, when a lot of it's going to interest and then and then principal, and then you could just pay more into your principal to
dump into the principal extra.
Yeah. All right. Now, in terms of, structuring your policy so it can work better for you, if you can explain what a term rider is and why it is beneficial to add it onto your policy.
Sure. Yeah, so term rider would be an addition or add-on, think of it, to a cash value policy, right? So I have a cash value policy. I might be paying in, 100 a month, upwards of 500, 1,000 even a month if someone has lots of income, or maybe 200 a month, a couple hundred a month, whatever it is, into that policy to have a certain amount of coverage, right? And a certain amount of cash value growth. Let's say hypothetically, there's an example, someone's contributing or paying in $250 a month into a policy. In the future, if they ever want to increase that coverage or what they're paying, what they're contributing, what they're funding into the policy, they can have what's called a term rider, which is just add on or attachment inside of their policy. It's just some extra life insurance coverage. It's typically very cheap, maybe a few dollars a month, nothing more than typically $5 to $10 a month for that extra coverage. So it provides extra coverage, meaning if they had 100,000 from the cash value policy or so, they could have a term rider maybe for 200,000. So it gives them extra coverage. And then also that term rider can always be taken and switched into more cash value, meaning, let's say I'm funding a policy $200 a month, and in the future I want to increase it to 300 or 400 or a certain amount higher. If I didn't have any term rider on a policy or with a policy, often what I'd have to do would be to go ahead and get a new policy and go through underwriting again, meaning just like they would have initially done, you have to reevaluate your health, potentially look at any medical records, potentially check blood work, ask you health questions, family history, all that stuff that, again, someone has to do to get a policy. If you have a term rider, you can obtain one without having to go through any of that, which makes it very convenient because you essentially lock in your health rating up until typically you're 60 years old is when you can switch that term rider into a new cash value policy. So it's a good amount of time.
So for an overfunded policy, when can contributions be adjusted? When can you reduce it? And when can you increase it? Is there a time limit to increase contributions again or reduce it?
Yeah, good question. So with an overfunded cash value policy, again, as a brief refresher, right, we have cash value policies in general. They could just be all base standard policies. But if again, you want to make them more efficient, you're going to have an overfunded policy where you're intentionally putting some money directly into your cash value, essentially. Those types of policies, you can always reduce that overfunding portion or stop it at any point. Meaning, let's say I'm paying in $300, contributing $300 a month into a policy, and 200 of that is overfunding dollars, or 100 is my base part of my premium. That 200 could be reduced or stopped at any point. So it gives you that flexibility. It could be year 2, year 5, year 10, right? That can always be adjusted. Now to go back up, let's say, hey, you're like, hey, I reduce it and then I want to go back up. You can typically do that as well after a few years, but you might not be able to do that like 10 years later. But typically in the first few years, the company would let you go back up as well to increase your funding. And then to fully stop, yes, there's a rule. It's called like the 7 pay test. If you Google or look it up, you just need to have some level of premium or funding into a policy for 7 years. Doesn't mean you have to do the full overfunding amount for 7 years, but any little bit, just a little bit of money going into your policy for, call it 7 years, and then you can fully stop paying on it. As long as you do those 7 years, then your policy will still be, it won't be classified as a MEC. What all that means is that when you go to access money, you can get basis out tax-free later rather than having to be taxed on that money you're first taking out.
Yep, you answered that for me. I was just about to ask you, how many years contributions have to be made to under cash value policy before it becomes optional. And
2 questions at once, right?
Which is good. And so did you answer this? How would stopping contributions affect cash value accumulation?
Gotcha. Yeah, I didn't touch on that. So yeah, if you stopped your contributions, your cash value is still going to accrue or accumulate, just not as fast. So typically the money in your policy, both your money in your policy and your death benefit, your coverage, right, it's going to grow or accrue over time. If I later stop putting any money into my policy, whatever that cash value is at that point, beforehand when I was funding it, it was growing based on the money that's already in the policy plus the new money I'm putting in. It was growing based on both, right? Existing money plus new money. Now, if I stop putting any money into it, it's solely growing based on that existing money in the policy. So it's still going to grow and accumulate, just not as fast because you're not putting new money in, right? So it's not like, oh crap, if I stop, I lose a lot of money. No, it's still going to grow and increase, and it's going to be guaranteed whatever's in there at the end of every year, or at any point. As far as in your coverage, typically similar thing, right? If you're using dividends to just cover anything any payments that you have or stop funding into it, coverage will stay around the same. It won't like decrease by a crazy amount. Might increase slightly, might decrease slightly, but would be around the same typically.
And when you say that, that means your death benefit, right?
Yep. Yeah, that death benefit amount. Yeah, like that all kind of depends on how long you funded the policy for, like what the death benefit would do. Like if you stop pretty early, it might decrease slightly. But if you have already paid in for, when I say early, I mean like before 10 years, but if you've already paid in for like 20 plus years, your coverage amount would probably keep growing or at least stay where it was at. But your cash value, you know for sure, even if you stop, it's not going to go down or decrease.
Oh, gotcha. It'll still accumulate, just not as fast.
Correct, because you're not putting that new money in there.
Now, what portion of the contributions go into base insurance and what portion goes toward cash value?
So that's going to depend on how big of a policy you have, but and another, like the larger the policy, meaning the more you're contributing into it, the smaller amount you can have towards your base premium. But typically, even a very large policy, the minimum you'd have going to your base would be maybe 15-ish% or so. So you can get it pretty small, right? Somewhere around there, maybe a little bit smaller, maybe a little bit bigger than that, but 15-ish%. But more commonly with like average size policies, maybe someone's funding it, I don't know, a couple $100 a month per se. Those might be where it might be two, three, four, 500, whatever it is a month. It could be larger or smaller, but those more average size policies, and you can typically get it to where maybe it's 25 to 30% is going to the base, and then the next 70-ish% is going to your cash value, almost directly in that overfunded portion. But that's where, again, I meet with when I meet with a client and say we figure out what are their primary goals, right? How are they looking to achieve, accomplish with it? If they want to have a good amount of coverage right away and they like cash value, yes, but it's not as important right away. Maybe it will be later. Maybe we don't overfund it that much and overfund a little bit, or not to give them flexibility, maybe not even at all. But, in other cases, hey, I want to drive the efficiency of this policy as much as possible. Then we figure out, okay, what's the max amount they can overfund it? Figure out, play with the numbers, figure out whatever that is to get them that max cash value efficiency of the policy.
And how long are contributions to base insurance required? I know you said that, but.
Yeah, no, important to read over. So that typically 7 years.
Okay.
Now, sometimes less, like if they're larger policies, because technically you can take some of the cash that's built up in that policy and just cover the last, call it 2 or 3 years of those premiums for you in years like 4 or 5, 6 or 7, but the policy-based insurance needs to be paid for 7 years, whether that's from out of your pocket or out of your cash value. In order to reason again for that is if someone who's not as familiar or educated in these topics tries to structure a policy very cash heavy or cash rich, they can wind up having it become a MEC or a modified endowment contract, which again would just mean when you try to take out money, that first money you're going to take out is going to not be tax free. Just defeats a lot of the purpose of using life insurance. You can get a lot of tax benefits with it.
Now, what is the interest rate that you would accrue with this policy?
Yeah, so that's going to vary. That's going to depend, of course, on what area you're using or company, and just over time, these interest rates can adjust up or down. But what's going to make sense for somebody is to use a company or a carrier that has a very long track record. And this I'll just kind of interject into this question, but right, you don't want to utilize a company that's been around for only a few years, doesn't have a consistent track record of paying out dividends in their policies. Also, what's going to make sense is also utilizing a mutual life insurance company. What that means is there's mutual life insurance companies and there's stock insurance companies. Stock insurance companies, when they bring in money from their policies or other means, any profit they're earning or dividends they have, they're going to pay out to their shareholders, right? So shareholders would be people that invest in that company. You technically own a tiny percentage of the company, right? Like I have share hypothetically in Tesla stock, where they have a small percentage of that company. It does well, I make money. They pay me dividends. It doesn't do well, I don't make much money, or I could lose money. Right? Stock insurance companies have both shareholders who have ownership of their company and also policyholders who have policies with them. So there's a divided interest there. When they earn profits, yes, they want their policies to do well, of course, but at the end of the day, they're often going to be most concerned about those shareholders. They're the ones that are investing in them. So you can see stock life insurance companies, oftentimes a lot of these policies actually, and I'll review them from clients, right? They'll will send me an email and we'll review it together. It's been a long time. Their policies coverage has not grown much at all. Their cash value is very minimal, and it's been sometimes 20, 30 years. The policy may even be at risk of lapsing. So I've unfortunately seen a lot of bad scenarios when someone doesn't go with a good carrier. Alternatively, going with one of the top mutual companies can mean a lot more. It just means a lot more efficiency and better growth, better value for your policy. These companies have been around for 150 plus years, and any profit or earnings that they make, they don't have any shareholders. The policyholders have ownership in the company. Any profits they make after they pay their bills and expenses, the profits get paid back to the policyholder in the form of dividends. So the policyholder gets all the dividends, they're going to get better growth. Now, to answer your question, so what I can pull up is from one of the top companies here out there. And this is one from Northwestern Mutual. So they have...
And that's the current one you work with and that I have, right?
Correct. So I'm licensed. I'm an independent agent, meaning I'm licensed with lots of different, all the top life insurance companies. So I can offer Northwestern. I can also offer other top companies like a Mass Mutual, New York Life, a Guardian, or just some other names. But all these companies have been around a long time. But this is one from Northwestern Mutual, which is, yes, what you have, what I have for myself.
Okay.
These are their dividend interest rates from the past, again, 150 plus years on the policy. So, of course, it's fluctuated up or down with the times, with economic conditions. So right now we look at, hey, what's going to be for 2025? 5.5% is your new dividend interest rate on their policies. So that dividend interest rate, then essentially we don't earn that right away in the policy. Of course, there's some costs or expenses associated with it, meaning, hey, it's also giving us life insurance. But over time, our cash value growth is going to come similar to what that dividend interest rate is over time, right? After we get through the initial cost or expense of the policy, we get more into that growth phase after the first couple of years, right? Especially if you overfund a policy. So what is it averaged? If we look at the past, call it 20 or so years, right? It's averaged in between 5.5 to 5.8%. If we look back 100 years, kind of same trend, average between 5.5 to 6%. 50 years, more so like 6.5 to 7.5%. So it's fluctuated up or down, but safe to say in between 5.5 to 6 if we look at long time horizons. It's at least what it's been historically, is what the dividend interest rate has been.
Now, what is the interest rate for borrowing against policy? If you can explain the net interest rate when you're considering, your accrued amount and the loan amount interest rate.
Sure. Yeah, I touched on the difference of those two. So to answer the first part of your question, what's the interest rate when borrowing? That can also depend on market conditions. That can fluctuate up or down. But at this point, for most policies, it's around like 5.7%, right? So what does that mean? Is that, and I'll actually draw this visually here so it'll be easier to conceptualize. So if that's at 5.7%, I'll use a simple example here. So let's say someone has $20,000 in their policy, hypothetically, in the future of cash value, and they wanted to utilize, call it $10,000, right? Now they're borrowing that out of their policy in the future. So they have access to that money. Now, of course, their coverage amount, their death benefit gets reduced if anything were to happen to them by that $10,000, but they're more concerned with, hey, they're still going to have a lot of coverage left, very likely. They're concerned with, hey, how can I utilize this as efficiently as possible? So how does that work is that $10,000 at the end of the year, once they've loaned it out for a year, they're going to have an interest bill for that policy based on that 5.7% interest rate, right? So if we do the math on that, it's $570 for the year. So that's kind of what they would owe, meaning they can pay it out of pocket, or they can have the policy pay for itself. As long as there's enough cash in that policy, it can just pay for itself. That's that $570. Now, what's the dividend interest rate now for 2025? We know is 5.5%. Now, if we imagine the future, again, this is subject to change, could go higher or lower, but assuming it's what it is currently, that means after we factor in, I think, the costs of expenses of having the insurance, we're going to get close to that 5.5. So let's say it's around 5.2 net percent, and if we apply 5.2% on that, call it $10,000. Interesting thing is that normally, let's say we take a loan from a bank, right? We borrow at $10,000. That money's not that we're loaning out. It's not earning or doing anything for us within the bank, right? It's loaned out. They're charging us for all of it. And we do whatever we want with that money. When you borrow from a policy, which again isn't going to be something you do in the first couple of years, but let's say maybe it's more so 10 years in, for example. When I borrow that from the policy, that 10,000, yes, I owe the interest, but it's also still earning interest as if it were still inside of the policy, meaning the insurance company is still paying me dividends based on this 20,000 all being in there. So I might earn, call it 5.2% on that money still. So that might be, for example, $520 of value I'm getting from that policy, plus the other 520 from the other 10,000 in there. So a total of 10,000, or not 10,000, excuse me, a total of $1,040 of total accrued interest from that policy. So in other words, okay, what's my net cost this year? More so around $50. Or if we subtract that from that, or so $50 that, hey, the policy could pay, or, someone could pay themselves out of pocket. So that's your interest costs is here. This would be your still growth in your policy as if it were still in there. So your net cost, come to think of it's averaging and could fluctuate up or down, but typically around maybe 0.5%.
That's awesome. That really caught my interest. And just to reiterate to everyone, the reason why I went with you was because of how well you explained it. So much so that I feel like you can explain this to a 10-year-old and they'll understand the basics of it. So, and I don't
that
like...
might be tough, but a smart 10-year-old.
Yeah, right. Yeah. So I know after anyone watches this, they'll get a really good understanding of what cash value life insurance is and how you can use it to your benefit. So much better than, to me, borrowing from a bank, like you said, because the interest loan amount minus the accrued amount that you're getting is 0.5% interest. Where do you see that for a loan at a bank? I don't know.
Please let me know.
Yeah, so I can get one. Another good thing too that I don't see at a bank, what is the repayment timeline on a borrowing against your policy? Tell them.
Yeah, so repaying that loan, right? You took $10,000 out, and in that example, right, based on what things are like currently, in that example, where you burn 10,000 out, maybe your interest cost might be 570, but then that money in the policy is still growing at around 520, but all the other money in the policy is growing at like 1,000, a little over 1,000, 1,020. So in that case, your policy values are growing by more than what that interest payment is, and that's going to happen every year consistently. In that case, you don't have to ever pay the loan back. Because, hey, my policy is earning more as long as my cash value keeps growing by more than what my interest is growing. There's never going to be a point where my loan is higher than what my cash balance is in that example. So I don't have to pay it back. Now, you can pay it back whenever. You could pay it after 6 months, a year, five years. Why would you do that? Just to reduce any interest payment. And then maybe you wanted to have your death benefit go back up to the full amount. Those might be reasons to do that. If you have extra cash flow, you can do it, but you never have to pay it back. Again, as long as we talked about, you can't loan out 100% of your dollars. You need to leave a little bit inside of the policy. So that way the policy never lapses. But as long as you leave that little bit amount in, that extra cash value inside of it, you don't have to be paying back the loan over time.
And that was honestly my next question.